But do I have a sense all five of you seem to think that if we see many of these social policies enacted, healthcare reform being, I assume, the biggest one, that would kill any long-term round?
Cap and trade.
Cap and trade, cap and trade, Peter Schiff, all the spending.
Well, obviously that's going to make a bad situation worse, but we're even further out on the leverage limb than we were a year ago.
What is this debt obsession?
And rates are going to go up. They can't stay down.
Debt is the only measure of how we're doing.
The Fed has parked a lot of bonds on the books of the banks, and they're sitting on them. Let's not say we're all leveraged out. It isn't like, you know, the consumers haven't been working down their debt and all the rest of that.
They've gotten started, but with they're nowhere near in good shape.
How long is it going to take,
we've been on a
Peter Schiff?
spending binge for a generation.
So how long does it take for the consumer to get back to where it was?
You think people aren't going to spend money for a generation? Come on.
No, we've got to save money. We've got to get our savings rate up to 10 to 20% and keep it there for a long time.
But Peter Schiff, how long?
Peter Schiff,
did
you look at the GDP data that was released this morning? There was an amazing thing which I want to throw out as a challenge to you. Do you realize that the consumption share of GDP
went up,
hit all-time highs this last quarter? What that means is that this theory that the consumer is just completely falling off a cliff and will never come back, and we're going to be in 25 years of scrimp and save, has simply not shown up one iota in the numbers.
So it's an interesting theory.
As scientists, it's not in
we're digging ourselves
data.
into a deeper hole. This is going to come to an end. You can't run an economy on spending other people's money. You run an economy on savings and production. We've got it completely backwards, and that's why we're in trouble.
And we're saving.
But we're not spending it. We're not spending other people's money. We're investing other people's money.
Let's make this actionable.
We're getting this money.
Jerry Boyer, what do you do right here based on what you believe about the market?
Well, if you're not in, you might want to wait for the next little correction before you get in, but I think we've got another little bull coming. And if you want to know where, I like technology because it's going to be a jobless recovery. Peter will get his inflation down the road, so you might want to start to get ready for that.
Peter Schiff?
Well, look, you can't be in cash and you can't be in bonds, so you got to own stocks. I just own stocks abroad. I mean, I think you got to be in Asia, you got to be in China, Hong Kong, Singapore.
Oh yeah, China.
You got to be in natural resources.
Peter, if America falls off the cliff, who's going to buy all of China's little lead paint toys?
Silver up 50 cents, gold was up $20. I mean, that's where you got to go.
Yeah, Russia and China, very stable. Great place to put your money.
How about
who's China going to sell their exports to, Peter? Peter, who is China going to sell their exports to?
They're going to buy them themselves. They're going to buy them themselves.
Oh, yeah.
Darn Luskin.
I want to know, what is the China story if the U.S. isn't there to be a customer? The idea that all of a sudden the Chinese are going to turn into a consumer society is just simply wishful thinking. There's not the slightest bit of evidence for it. It's an idea, it's a theory, it's interesting, it's a great narrative, but where's the data?
They can buy their own stuff. There's a billion Chinese. As long as their government stops buying our bonds and stops suppressing their own currency, you're going to unleash massive purchasing power in China.
That's a big if.
Because American government could have bought this mortgage security at a discounted value, so when the housing market recovers, that could have been a very good return for the U.S. taxpayers.
Peter Schiff, I hear you chuckling already. I know you're opposed to this plan. You've argued we need a recession to solve our economic problems. Is that where we might be headed?
Well, I'm just laughing about the housing market recovery. I mean, we've got a long way to drop with or without this plan. I mean, part of the problem is housing prices got much too high. They're still too high, and they're going a lot lower. And, you know, people shouldn't be borrowing money to overpay for houses.
All this fear about debt, is it fear-mongering?
It is fear-mongering, and thank you for noticing that interest rates were much higher a decade ago than they are today. The United States government does not have and is not going to have a problem financing its public expenditures and its deficits. It's simply not an issue that should be on our list of things that we really care about right now.
Peter Schiff.
Well, you can see that I'm laughing. Well, basically, you know, the reason that this is happening, it's not magic. The U.S. government is making the same mistakes that subprime borrowers did when they were using teaser rates on their mortgages. We have a $12.5 trillion debt, as you state. First of all, that doesn't include any of the off-budget items like the debt of Fannie and Freddie, and it certainly doesn't include the unfunded liabilities, which dwarf that number. But if you just take the funded debt and you look at where it's going to be in a year or two, it'll be around $15 trillion. What happens if interest rates go up to 10%? which is half of where they were in 1980. All of a sudden, we're paying $1.5 trillion a year in interest on the national debt. You see, the term on the national debt, the maturity is very short. The government is not borrowing for 30 years. The government is borrowing for 30 days. There's a lot of short-term paper. This is a teaser rate on an adjustable rate mortgage, and we are headed for disaster.
Now he makes the case there, Professor Galbraith. What's your response to that, likening it to a subprime mortgage and fairly pointing out a lot of this debt is short-term borrowing? It's got to be rolled over.
Yes, but the government can, in fact, borrow for 20 years at a rate which is now running at 4.5%.
No, not if it tried to do it. If it actually tried to do it, rates would go up.
Well, that's a rate which tells you that the capital markets are not, in fact, worried about this, whatever this actual scenario is, that somehow the capital markets are going to turn around and say that the U.S. government cannot finance itself.
The only reason
if it can finance itself for the short term at zero, it should do so.
No,
perfectly reasonable thing to do.
The reason that the federal government isn't borrowing in the 30-year bond market is if it tried to refinance the short-term debt long-term, it would destroy the bond market. Bond prices would collapse and interest rates would go through the roof. The only reason long-term rates are so low is because the government isn't borrowing at the long end.
Peter, what about the question, though, that part of this comes down to there is a pool of money out there and it wants to go somewhere it perceives to be safe. So the U.S. may have a problem, but I mean, look, Greece has been in default half the years it's been in existence. Spain, Portugal, you name it. I mean, the U.S. may be bad, but it may be better than anywhere else, and maybe that's why rates are low.
Greece didn't have it. Nobody was talking about Greece's problem 6 months ago. All of a sudden, it's a problem. The United States is the next Greece. You know, we're going up the food chain in sovereign credit. We are the worst offenders. We owe the most amount of money to the most amount of people all around the world. We have this giant credit bubble, and when it began to burst in 2008, we didn't solve the problem. We made it worse. We have a much bigger problem coming in the years ahead when the U.S. government bubble bursts.
The difference between the United States and Greece is that Greece is a member of the euro, and Greece has to fund itself in a currency that it cannot control. The United States is in full control of its own currency.
But that's the bigger problem.
We can have some problems. I'm not just saying that we are free, we've solved all economic problems. I'm saying financing the government of the United States is not one of the problems that we face.
Sure it is. See, the fact that Greece can't print money, that's a good thing. The fact that we can print money to repudiate our debts with inflation, that's not a good thing. Anybody who's holding U.S. government bonds, basically what you're saying is, it's okay, the government's going to print a bunch of money,
as I say
you're going to get paid.
If the markets were seriously worried about the prospect of inflation, they would not have a 4.5% rate on 20% bonds.
The markets are wrong. Look, just like the markets didn't see the subprime problem until it was too late. Look, gold is at $1,100 an ounce for a reason. It didn't go from $250, 10 years ago to $1,100, $1,200 without people worrying about inflation.
Since 1980, we go to that problem. It doesn't look so good.
So you're telling me that this is all tied to the price of gold is the oracle that we should be following?
Well, you should be following something. Don't be following the Federal Reserve. You know, to say that because interest rates aren't high, the market has consistently gotten things wrong. You know, I was on this network, CNBC, back in 2005 and 2006. Warning about the housing bubble, the collapse that was coming, the problems in Freddie and Fannie, the problems with the financials. No one believed it. People were laughing it off. You know, all of a sudden, these things happen.
That if the markets truly are as inefficient and irrational as you should say, then we should tax them and we should regulate them to a fairly
they're already taxed and regulated. That's part of the problem.
Let's take a pause there.
Peter, if you had to choose, which are we closer to, Greece or Japan?
Well, man, out of Greece, Argentina, Zimbabwe, I mean, we're nowhere as near Japan. I mean, we're not going to get off that easy. See, when Japan started making its mistakes, it did it with a position of strength. The Japanese had significant domestic savings. They had huge trade surpluses and current account surpluses. We're at the opposite situation. We've exhausted our domestic savings. We have a huge trade deficit. We can only borrow money if the Japanese and the Chinese and the Saudis lend it to us.
But importantly, we have inflation at 40-year lows, and we have a very high rate of underemployment or employment.
The Fed's balance sheet has grown by 150% in the last 2 years. That is massive inflation. The fact of the matter is that prices should be falling in the United States. They're not. They're rising instead, despite despite that, because of all the inflation that's been created by the central banks. And, you know, when foreigners wise up, when they stop buying our bonds, you know, then you're going to really start to see a collapse in the value of the dollar, and prices are going to be going through the roof. And that's also going to send interest rates up, and that's going to really exacerbate the ability of the U.S. government to pay the debt, because we've got it all financed with Treasury bills. But when interest rates go up, it's impossible for us to pay off the debt without printing even more money.
Mike Musa, do you see that?
No, I think we're about 6,000 miles from Japan and about 6,000 miles from Greece. Our situation is not in any way comparable to either one.
Why do you say that? Explain.
Well, we are growing much more rapidly than Japan. Japan grew 1% in the 90s, grown 0.5% this decade. We grew 3.5% in the 90s. Even with the deep recession, we grew 2% in this decade. So we're much stronger there. And as far as Greece is concerned, we have a record of fiscal probity, having brought our debt to GDP ratio down several times in the post-war period.
Yeah, you know, first of all, we're not actually growing. Our economy isn't growing. The GDP is going up because we're spending borrowed money. But all we're doing is spending more. It's not our economic output that's increasing. Meanwhile, our debts
most certainly
are rising.
Is our economic output that's increasing.
No,
we're
it's
growing,
not.
as the NABE suggested, 3% this year.
No,
I think probably 4%.
Yeah,
and we will have a relatively normal cyclical recovery. To say otherwise is just a lot of nonsense.
No, it's not nonsense. All
yes,
we're doing
it is. Absolutely.
No, the government is spending money. Consumers are spending money. It's not economic growth. We're destroying our wealth. We're going into debt. The debt is rising much, much faster than these phony GDP numbers.
The GDP numbers are not phony. You're just speaking a lot of nonsense.
No, I'm not. I mean,
yes,
that's
you
what
are.
people...
Absolutely.
No, look, I don't speak nonsense.
Yes, you certainly do. If you say that our gross domestic product is not growing, you just don't know what you're talking about.
No, the GDP is growing because it's made up of government spending and consumer spending. But where are they getting the money to spend? We are borrowing
government
it. And
spending growth accounted for about 1/10 of GDP growth over the last 4 quarters.
What, all this money that the government is spending, you don't think that's part of the GDP? It's a lot more than that.
Okay.
All the
real government purchases about 10%
the money that the consumers are spending, they're getting from the government.
Yeah, first of all, Simon, you have to understand, when you talked about the fact that a borrower, when he gets to refinance his mortgage, he wins because he has lower payments. Well, that's a zero-sum game because the lender loses. His cash flow is diminished by the same amount. Now, the problem is you've got all these banks that own these low-yielding mortgages. They're surviving right now because the Fed is making up the difference by giving them money for free. But when that bond bubble bursts and the Fed is forced to raise interest rates, and all of a sudden rates aren't zero, but what if they're 7%?
How about the velocity of money? Hold on a second. I mean, you've got consumer spending, you've got banks that are getting money cheaper from the government, they're lending it cheaper. Money is churning through the systems, exactly what the Fed wants.
No, but you're missing the point that we are putting ticking time bombs on our financial institutions. They're holding 30-year paper where they're yielding 4 and 5%, but they're borrowing money for nothing from the Fed. When the Fed raises interest rates...
Your assumption, again, is that the Fed is about to blow up. All we're talking about is about a bridge for consumers. They have more money to spend.
Let me finish my point. At some point in time, interest rates have to rise. And when they do, all the banks will fail because their balance sheets can't survive it. So we're setting up this explosion.
You were probably saying interest rates were going to rise, about 6 months ago.
Hyperinflation.
So are you going to tell me that we're never...
People said we were going to 5.
Are you going to tell me...
going higher?
Are you going to... Is it impossible that the Fed funds rate can ever get back up to, say, 7% sometime in the next 5 or 10 years?
Not in my lifetime.
So in your lifetime, in the rest of your life...
Not anytime soon, no.
We have to leave it there.
I got to ask Peter. That's just ridiculous.
The question, Michael, is just in case we end up with deflation, some people say there is a possibility of that. You have some money there because then that trade pays off.
Yeah, we can also be hit by a meteor.
That's exactly right, Michelle. And again, what I'm hearing is the case for broad diversification in this discussion right now.
Peter, I heard a funny snide comment there. What was it?
Well, I said, we could be hit by a meteor too, but I'm not going to prepare for that. We need deflation. Unfortunately, we're not going to get it. That would be healthy. What we're going to get is runaway inflation.
Well, we are getting deflation.
No,
wait a minute. We are getting deflation in housing
Where do you
prices.
shop?
We're getting deflation in a lot of asset classes.
But that's not
We're seeing deflation in real estate prices all over the country.
No, but that's not deflation.
We could experience, but Peter, and I agree with you on most stuff, but we could experience what Japan did. Japan had deflation for 20 years.
That's not deflation. If real estate prices are too high and they come down, that's not deflation. But you know what? The cost of owning a house is going to go up. Even though prices are coming down, utilities are going to go up. The cost of maintenance is going to go up. I mean, go to the grocery store. Are food prices falling? Go to the gas station. Where do you see consumer prices falling? They're not. They should be falling, given this huge contraction we had in the economy. But the Fed created so much inflation, prices are rising.
Suffice it to say, you don't think it's worth putting on a few percentages of your assets into treasuries for the just-in-case scenario? You don't think it's a possibility?
I would put 0%. Buying treasuries today is like buying dot-coms in 2000 or buying condos in Miami or Vegas in 2006. It is the sucker's trade of the decade. The only thing worse than owning U.S. dollars today is owning a promise to be paid U.S. dollars in 10 years or 30 years.
Okay.
Do not touch them.
Don't move.
Peter, it's great to see you.
Yeah. You know, first of all, I don't want to go broke. I don't care if it's in an orderly manner, right? So if you're telling me the dollar is going to lose value, but don't worry, it's orderly, I'm not going to stick around for it. I'm going to buy gold. I'm going to buy euros, Swiss francs, Singapore dollars, Australian dollars. I'm going to get out of Dodge. I'm not going to stay here and get shot.
In terms of the dollar falling to uncharted territory, which is what you say, what does that mean exactly? What sort of levels are we talking about?
Look, I don't know. It's a bottomless pit. You know, normally when we've had these meetings of the G7, G8, now G20, when they come when the dollar is making a record low, which it's doing, normally the talk is we're going to prop up the dollar, we're going to have coordinated intervention. Now the talk is let it drop. We're not going to interfere. We're going to let the fundamentals determine exchange rates. Well, if the fundamentals determine the dollar's exchange rate, it's going a lot lower, and it is not good news for Americans.
Peter, always great to speak with you.
Yeah, well, you know, QE2 is certainly going to weaken the dollar, but more importantly, it's going to weaken the U.S. economy. You know, we can never have a recovery while the Fed is doing QE. You know, any jobs that are created or any economic growth that is generated by QE2 will evaporate as soon as they stop doing it. So when they stop, then we're going to be in worse shape than we were before they began, and now they're going to be forced to do QE3, and the more they do it, the bigger problem they end up creating. The best way to allow the economy to recover is for the Fed and the government to get out of the way and let the market function.
First of all, Peter, I like a man who's got a lot to talk about, starts right out of the gates with what he wants to say. Got to commend you for that. But I do want to ask you about today's jobs report. I mean, doesn't it show that perhaps there is life in this economy and that this, you know, QE2 could just be a stopgap measure until the economy actually improves?
No,
we're seeing signs of it.
We created the wrong kinds of jobs. We lost manufacturing jobs. We need to create manufacturing jobs. So the service sector jobs that we created are just going to result in a bigger trade deficit because we're creating consumers, but we're not creating producers. We are adding to our imbalances. If the government got out of the way, then we would be losing service sector jobs and creating manufacturing jobs. That would be progress. What we're doing now is digging ourselves into a deeper ditch.
But in terms of the stock market and the economy are different animals. The stock market's rising on QE2, rising even on the possibility of QE3 because the dollar's going to weaken. And right now there's a very strong inverse correlation between the dollar and stocks. So if you think the dollar's going to go down more, that doesn't necessarily spell trouble for the stock market.
But it doesn't make you richer. You see, when the government does QE2, everything goes up. It's not just stocks that are going up. Oil's going up, food's going up, gold's going up. The dollar is losing value. So even as the stock market has a higher dollar value, people that own stocks aren't any richer because when they sell those stocks or they cash in their dividends, then they go and buy food or buy gasoline. It's going to be more expensive. So it's all an illusion created by the Fed.
Hey, Peter, I'm going to get to Brad in a second. But Peter, I remember this. It was, we're going to create jobs. Stimulus signed it away February 2 years ago, create jobs. And all of a sudden they realized that there was no way to quantify that. And they said, oh, wait a minute, did we say we meant create and save jobs? Here we are. 7 million jobs lost since Obama took office. Yet today we hear they created 900,000 jobs. Where?
Well, you remember, the government can create jobs, but they can't create purchasing power. Remember, in the Soviet Union, everybody had a job, but you waited online 8 hours to buy bread. You mentioned earlier that if you were afraid President Obama is going to try to take credit for the economy. Don't worry about that. In 2012, the economy is going to be much worse than it is today, and the president's going to be trying to blame the weakening economy on the Republicans in Congress. That's what's going to happen.
I really don't. I'll go out there and on a limb and say I think it's going to be vastly better in 2012, and I think it's simply because the consumer hasn't spent, and eventually it feels like that boat is turning. Brad,
the consumer is broke, and the fact that he's spending now is part of the problem. We're digging ourselves into a deeper hole.
Consumer's always been broke, Peter. You and I both know that. The American consumer's been
broke. He's never been
this
broke, and the government is broke too.
No doubt. All right, go ahead, Brad. Wait.
But barring some sort of unforeseen event, the law of cycles dictates that the economy will probably do better in the next 2 years. But then Obama's faced with a very difficult decision because in 2012, the tax cuts that he lobbied for against his far left base are going to expire. Now, people will say, hey, those tax cuts helped get us to where we are today. What's he going to do? Is he going to go, okay, is he going to go out there and say, okay, now it's time to raise taxes again? He's going to be facing the exact same debate that he had now, but now not on an off-season election, now on a presidential election.
Well,
and he's in trouble.
Don't be so sure that the
conundrum
economy is going to be... What if interest rates move up dramatically? What if oil prices are $150, $200 a barrel? Why would the economy be better?
Oh, because Peter, the only way oil moves up to $200 a barrel is because the economy is better.
No.
Come on,
what if it's because the dollar's losing value? What if it's inflation?
The last time oil was $147 is when we were hitting on all cylinders.
No, we weren't. We were a bubble. We weren't hitting on any cylinders. It was a bubble about to burst. The only reason that oil fell.
That's what the American economy is. It's one bubble to the next bubble. It was an internet bubble that became a real estate bubble.
We're out of bubbles.
Perhaps. Go ahead.
Well, the economy's been so low it has nowhere to go but up. But I would say
it's got a long way to go down.
If I was basing everything on the Bush administration, I'd have to agree with you guys and say the government doesn't create jobs. But if I base it on the Clinton administration, I'd say the government can create 20, 25 million jobs.
It can create miserable jobs when you have nothing to show for it.
This is important, Peter. What happens if Obama now gets 2 years of pushing back the tax rates and does what he says he's going to do, starts looking at the deficit, looking at the debt starting next year, and that starts to come down? I mean, boy, that could be pretty powerful
The debt's not coming down. The debt's going up. What are you talking about?
I'm saying if he attacks it, if he goes after it. I mean, there are ways to do that.
Well, how's he going to go after it? He's going to have to cut spending. He's not cutting anything. They're ignoring the deficit.
Right. So this is a multi-layered discussion. Let's first start out with the underlying premise that Meredith Whitney has, which she says we've got a muni meltdown coming, that these guys are not, the states aren't going to be able to pay their bills. Peter Schiff, is she right?
Well, I saw that 60 Minutes program. I think she's sugarcoating it. You know, I've been telling my clients to sell their municipal bonds for years because I could see this train wreck coming from a mile away. I mean, the problem is you had all these states and local governments that made all sorts of promises, particularly to their employees, in terms of pension benefits, health care benefits. They borrowed a lot of money in the process. The bills are coming due. The taxpayers can't afford to pay. They either have to default on their promises or default on their debts. And the worst possible scenario is that the government bails them out.
We're going to get to that, but hold on. That's the second layer discussion. But Don Luskin, do you agree with the underlying premise? Are we at some point here where we've just got a crisis when it comes to municipal bonds across the United States?
Well, look, I didn't hear Meredith Whitney or Warren Buffett use the word meltdown, use the word crisis. You know, really, let's all get a grip on this. We know that there are all kinds of financial stresses throughout this economy and throughout all the developed economies in the world. The good news is that we're coming out of a very deep recession, and recoveries are like a wonderful medicine that makes all problems at least a little bit smaller. All right? So, look, whatever is going to happen, I mean, I happen to be talking to you from California, which is always said to be the Greece of the United States. This is supposed to be where all the problems are. And in case you haven't noticed, the lights are actually on. Okay?
So if I understand you, John, you're making the point that, okay, there can be a lot of defaults, but it's not necessarily a systemic crisis that brings us all to our knees.
Yeah, why should it be?
Peter Schiff, okay, so it's going to be bad. You shouldn't own the muni bonds, but is it going to lead to the debilitating 2008, you know, everything's on fire situation, or is it just going to be a round of defaults and we're going to get over it?
I think the municipal problem is part of the larger crisis that is coming, because as interest rates rise, it's not only going to be the states that can't pay, but the federal government that can't pay, and more pressure is going to be put on the Federal Reserve to be the buyer of only resort to continue to print money, but not only to buy treasuries, but to now buy municipal bonds to prevent them from having to default.
Ben Bernanke is going to be buying Harrisburg's water? That's what you're telling me?
They're going to start buying everything and printing money to do it. And that's, you know, you're going to see more increases in commodity prices, food prices.
Peter, exceptionally low for an extended period.
Yeah,
where you been, man? I mean, that's been the quote from the Fed for the last several months.
That's what they're saying. But as consumer prices really start to move higher, as the dollar starts to tank, as long-term interest rates start to spike, can the Fed really maintain that posture?
Hey, Peter, if we have these higher rates and we have an economy that at least is chugging along, why would the dollar fall apart? If I look around the world, I want to buy dollars. I get a higher rate.
No, the dollar, look, if you throw out the euro.
We had $600 billion of QE come in, and the dollar went up.
No, it went down. You're looking at the euro. I mean, Europe has problems too.
I'm looking at the U.S. dollar went up since QE.
Look, this Australian dollar was up 16% this year. The yen was up 13%. The Swiss franc was up 12%. Gold was up 27%. Silver was up 75%. How do you see the dollar going up? The dollar went down.
Since QE2, the dollar has gone up. You're mentioning those things from the beginning of the year. Yes, it has. Look at the Dixie. Look at the dollar index, which of course is versus the euro. Look at that. The dollar has gone up. The interest rate differentials are changing, particularly with Europe. If you look at the euro 2-year rate versus the dollar 2-year rates, it's the smallest spread we've seen all year. Things are changing. They don't always have to stay the same.
Let me get Weiss into this discussion. If this was a hockey game, we'll call him the third man in.
I don't want a fighting penalty. The CRB closed the year at a 2-year high.
Peter, let me ask you this. In terms of, I don't know how you don't see the euro going lower and the dollar at least holding on or moving higher.
But who cares about
the price? Because we're an export economy right now. We're
an export economy. We're running a huge trade deficit.
We're running a huge trade deficit with China. In terms of the dollar, though, let me just finish. In terms of the dollar, though, that's where I'd want to be if I were a global investor. You need China to bail out Spain. You need China to bail out, to come to help bail out Europe. The Germans are getting tired of doing it. The French are getting tired of doing it. You know, UK, they've got their own issues. So you want to buy dollars, not euros.
No, remember, if China tries to bail out Europe by buying euros and buying European bonds, they're going to sell dollars to do it. They can't prop us both. They have to make a choice.
They've got a big surplus. They can do what they like.
Or they want to prop up the U.S. I think they're going to choose Europe and let the U.S. tank.
I don't see that. We're their biggest trading partner.
Well, Peter Schiff, with all due respect, has an argument that's fundamentally wrong right now. He, like many people, asserts that the increase in the money supply is what's driving the increase in commodity prices. However, if you take a look at the money supply, the trend line going back from the start of the decade until the day before Lehman collapsed, we are effectively, at this moment, right where we should have been had September 2008 not happened. So while the money supply might not be going up fast enough for you, it doesn't change the fact that the money supply is exactly where it should be. The Fed has not expanded the money supply.
Sure. Where do you think it's getting all the money to buy all these bonds?
The money supply is going up, is exactly, the point that it is at is exactly where it would have been had the pre-Lehman trend continued.
Well, sure, and the pre-Lehman trend was inflationary. You remember where commodity prices were in 2008? They're still lower than they were then. They were going off the charts. Oil was $150 a barrel. Some of the commodity prices were a lot higher than they are right now because all the inflation that the Fed was creating prior to that. But here's the big difference right now. We've been exporting our inflation all around the world, particularly to countries like China. They are choking on it right now. Prices are rising rapidly. They have had enough.
And what they have to do, rising rapidly.
In China, sure they are. Take a look. And also in Latin America. And what the Chinese are going to realize is that they have to stop importing our inflation. They're going to let their currency rise sharply. That will bring prices down in China, and that will send them soaring here in the United States.
Their currency should rise, Peter. Yes. Their currency should rise.
And when their currency rises, our currency is falling. So prices are falling for the Chinese, and they're going to be rising for us. And when the Chinese stop buying our paper, they also stop buying our treasuries. So interest rates rise, commodity prices, consumer prices rise, and then the Fed's going to be in a real box because it's going to have to get very aggressive on interest rates when the recession is worsening. The Fed doesn't really care about the actual rate of inflation. The Fed is trying to use these phony government numbers as cover to keep creating inflation, which is what the Fed wants to do because it wants to bail out the politicians in Washington who want to keep on deficit spending.
Well,
if we had any central banker with integrity, he would be raising interest rates and forcing the government to cut spending because we're never going to have a recovery. What we're doing now is we're spending more borrowed money, and as we're spending ourselves deeper into debt, we're pretending the economy is growing. It's not. We can't really grow the economy until we shrink the government.
Peter, nowhere in the Fed's mandate is it required to facilitate or prevent government spending. I agree with you that there's a problem on the fiscal side of things, but it's not the Fed's job to get in the way of that.
Well, no, yes, it is. I mean, the reason we have an independent central bank instead of the Federal Reserve being an arm of the Treasury is so the politicians can't have their debt monetized. They're supposed to take the punch bowl away. They should be tightening. They shouldn't be worrying about the fiscal about the consequences.
Peter, let me ask you. It's interesting. Wait, let me just quickly add one more quick thing, Larry. We quote unquote tightened in the summer and the fall of 2008 when this same I feel the feeling I forgot from that time because the PRB was going straight up, oil was at 140, and the Fed paused, and the second half of 2008 was atrocious in part because the Fed tightened implicitly.
No, it was atrocious because the Fed was too easy in the years leading up to it.
The falling commodity prices tells us the Fed was not loose enough.
No, they were too loose from 2001 all the way to 2007. It was that cheap money that inflated that housing bubble. It's the reason that everything went up.
Just the last
one. Look, the Fed shouldn't have given up.